Partner with Verrill. Cheryl has a diverse business law practice, including taxation, entity structuring and operations, business planning, and specialized securities law matters. Having broad experience in transactional tax matters, including domestic and international transactions, mergers and acquisitions, restructurings and financings, exempt organization, business planning, partnership, limited liability company organization, taxation and operations, and business succession planning. Cheryl advises clients, outside counsel, and key client business advisors on when to go forward with business dealings and when to walk away. Cheryl also has a broad practice advising investment funds and their advisors, including private equity funds, funds of funds, and hedge funds, and opportunity zone funds. Gregory Fryer is a partner with Verrill. Greg has been a trusted legal advisor to companies and investors for more than 30 years, guiding them through stock offerings, acquisitions, and corporate restructurings. During his career, he has given special attention to the challenges startup technology companies face in raising capital. Greg has received recognition for his skill in matters of corporate law and securities law. So with that, we will let the two of them begin the presentation, and just please ding me when it's time to advance the slide.
Okay, thank you, Joan. Well, good morning. Very happy to be here on behalf of our firm, Verrill. Our firm has an office in Boston, but today you're hearing from lawyers in Portland, Maine, and Westport, Connecticut. So we're a New England wide law firm. So today we're going to be talking about legal and tax insights into how to prepare your company to establish in the U.S. I'll be talking about more of the corporate law issues, and then Cheryl will be talking about some of the some very specific and interesting tax-related issues. There are many reasons to establish a U.S. presence. Vincent, what was your reason for wanting to establish a U.S. presence, if I might ask?
Sure, Greg. Yeah, well, we're fundraising at the moment, and we're looking to engage with U.S. investors. Our plan is to launch products in the U.S. next year, FDA approval pending. So we wanted to get a base there and get set up and expand our network.
Great. Okay. Well, that's a very common reason for technology companies, foreign technology companies, to establish in the U.S. is to get access to what is a really remarkably robust capital market in the U.S. Other reasons include the opportunity to affiliate with a number of innovation-friendly organizations in the U.S., including Action Innovations, which you've already done, but hospitals and other research centers around the country. Obviously, there's a large and vibrant U.S. consumer market that a lot of companies would enjoy, tapping into. Anyway, so lots of different reasons to establish a U.S. presence. The simplest way of doing it, perhaps, is to just simply open a branch office of your foreign company. There's no actual requirement that you form a separate U.S. entity. You could just, sign a lease and start work as a branch office, essentially. However, almost always foreign companies, will establish a U.S. entity. That's important as a liability shield to protect the assets back at home from any liabilities that might arise in the U.S. It also simplifies matters somewhat on the tax front and protects, to the extent you have income in the home country, you certainly don't want it to be subject to U.S. taxation in addition to home company taxation. So establishing entities helps sort that out, and Cheryl, is well qualified to discuss those sorts of matters, although I don't think she will today because it's just simply too big a topic. So, in terms of entities to consider forming in the U.S., there are two classical forms of entities. One is, so we should I should probably get better at this. Joan, I'm several slides in, actually.
Oh,
So let's see. So so the next slide after this cover sheet. Okay, so types of business entities to consider. Corporation and partnership are the two classic forms of entity in the US. Corporation is a hierarchical structure. You've got shareholders who elect a board of directors, who appoints the officers who run the business. A partnership is a more circular type of organization where the partners who own the company in the classic partnership also run the company. And they decide between themselves as a matter of contract who does what to whom. Now, so in the most common form of entity to consider for foreign companies would be the corporation, just because it's well known and it provides a nice tax shield for investors. Again, another complex issue that Cheryl could discuss. In the US, there has arisen this very interesting and useful entity called a limited liability company. It's sort of a hybrid between corporate hierarchy and a partnership structure. So it's very, very flexible. It can be hierarchical, it can be circular. The owners can run the business, or the owners could appoint a board. Lots of different options, and thus lots of different complexity. The corporation is itself an entity that gets taxed, and so that gives rise to taxation both at the entity level and then when profits are distributed up to shareholders at the shareholder level. This is known as double taxation. The partnership is a pass-through entity. It does not itself incur income tax, but instead the taxes are allocated among the owners. The limited liability company generally is structured as a pass-through, but it also, under US law, can elect to have a corporate tax look to it. It can elect C Corp status. And so all of these decisions are ones that, in the first instance are driven very largely by tax considerations. After that, the fine tuning may very well be dictated by the desires and demands of the investors, of the outside investors. So next slide. So choosing the jurisdiction of formation. In the US, we have what some would consider a crazy system where corporate law is governed by each of the individual states. We've got 50 states and a couple of other jurisdictions that are possible situs of formation. In the US, the dominant jurisdiction for formation is Delaware. Delaware has a modern statute, both on the corporate side and on the LLC side. A very large body of case law. It's got an outstanding court system that's dedicated to these sorts of issues. And because of the case law and the court system, it's thought to have a greater predictability when it comes to, in the event of a fight among participants in the corporation or the LLC. Delaware also is a set of rules familiar to most corporate lawyers throughout the US, no matter what state they live in. And there's no state corporate income tax in Delaware. And for these and other reasons, when you have outside investors investing in your company, very often they will prefer that you choose Delaware because it's familiar to them and dependable for them. Forming in Delaware does involve some added expense. If you have operations in some state outside of Delaware, and Delaware itself is a very small state, you'll need to qualify to do business in the places where your other operations are, generally speaking. And so that means essentially being registered in Delaware and being registered in the state where you have operational facilities. It's not a complicated matter, though. It involves some expense. There's also some added expense whenever you have two different, sets of laws governing you. Your employees generally will be governed by the laws of the states in which they're working, whereas the corporate matters or the LLC, governance matters will be governed by Delaware law. It just means you might end up having two different sets of lawyers. So next slide, please. So U.S. subsidiary versus Delaware flip. So to form a U.S. subsidiary, what the foreign company would do is simply organize a U.S. corporation and own all of the stock in that U.S. corporation. So you have the parent company and then the subsidiary in the U.S. Investors typically like to invest in the top tier organization within a multi-company structure, and U.S. investors typically like to invest in U.S. companies because U.S. companies have laws that they're familiar with and that they trust. If you form a subsidiary and you also are looking for U.S. investors, your U.S. investors will have to take their choice. They'll either have to invest at the foreign company level in order to get to the top of the pyramid, or they'll invest at the subsidiary level where they're more familiar with the laws, but where things could get lost in the shuffle between the subsidiary and the parent. If another structure is possible and is actually quite common, the so-called Delaware flip. If you take if you organize a U.S. corporation and then have the owners of your home company, your foreign company, swap all their shares in the foreign company for shares of the U.S. company, what will happen is you'll have your, immediately following that transaction, you have your foreign owners at the top. They will own all the shares of the U.S. corporation, and then the U.S. corporation will own all the shares of the foreign company. So it's just the upside down version of a U.S. subsidiary. The U.S. company essentially becomes a holding company, and then from there are lots of different possibilities. The U.S. company might be purely a holding company, where the foreign company is the only operating company, or the U.S. company itself might have operations. This all can get quite complex, and again, you'll want to involve lawyers and accountants to help design a structure that works best for you. But this Delaware flip does have the advantage to investors that the U.S. investors anyway are on their home court. Now, obviously, your foreign investors will have to live with that, because that's the flip side. However, if you've got a situation where the U.S. market is hoped to become the dominant market for your company, or if it's hoped to become the dominant source of capital for your company, your foreign owners may be very happy to provide that flexibility. So next slide, please. So generally speaking, the U.S. is friendly to foreign businesses, working in the U.S., and is very friendly to foreign investors. But there are two regulatory regimes that I'd like to talk about for a minute. The first is called CFIUS. So CFIUS, if I can go to the next slide, please. CFIUS is the Committee on Foreign Investment in the U.S. It's a complex and mysterious organization. It's actually made up of a bunch of different government agencies, and their sole focus is on national security. CFIUS operates largely in the dark, and it has very broad powers to come into a transaction even years after the closing, and insist on changes in the structure or even divestiture of assets. In the case of your companies, it's highly unlikely that CFIUS will be a real problem for you, but there's a very good chance that in your investor documents, the investors will ask questions about CFIUS exposure, and will maybe even make you issue representations and warranties that you're either not subject to, or that you've already filed, or what have you. So it's a complicated situation, but probably one that won't apply to you at all. And you can, at your leisure, you can study the information that's on the slides. Next slide, please. So here again, not going to go too much into the details, but CFIUS, its powers were recently expanded, and it mostly pays attention to what is the acronym known as TID. So either critical technologies, critical infrastructure, or sensitive personal data. Those are the triggers that are most likely to result in some kind of CFIUS review. They're now, it used to be that CFIUS, that you could file with CFIUS, you file disclosures with CFIUS in order to seek clearance from CFIUS. That was purely voluntary historically, and remains largely voluntary. There are now some types of transactions for which filings are mandatory. These are unusual transactions, though, and are unlikely to be triggered by by your own companies, at this level. But do keep in mind that your companies might very well, for example, collect sensitive personal data about U.S. citizens. Generally speaking, CFIUS doesn't really look at it unless you have plans to collect data on more than 1 million Americans. But if you are planning on collecting DNA data in any amount, that could potentially trigger interest at the CFIUS level. So in any event, I wanted to familiarize you with this term CFIUS, and just let you know that as you get into your investment planning, you'll want to discuss with counsel whether you should be doing anything regarding CFIUS, or what kinds of CFIUS reps and warranties you can expect in your documentation. Next slide, please. So then there's the BEA. So in the US, we love to count things. And one of the things that we count is foreign investment in the US and US investment in foreign companies. And there's this little known agency called the Bureau of Economic Analysis. And they have census forms that that your companies will need to fill out in all likelihood. So there's a set of forms called the BE13 forms. These are your entry point into the system. This is where you essentially register, get on the roster of being foreign companies that are operating in the US. The most likely form would be BE13B, but you should also check to see if you're exempt from these filing requirements. The exemption is not self-executing. You'll actually file for the exemption, and basically you'd have to be a quite small enterprise to escape filing of the form BE13. Once you're into the system, there are annual census forms that need to be filled out, typically on BE15, but here again, there may be exemptions to filling out those forms, and those exemptions will be self-executing by and large. So that's a set of filings that are easy to overlook. They have potential, penalties that rack up over the years. It's worth noting this is not a difficult requirement to comply with, just so long as you're aware of it, and now you're aware of it. So I think that wraps up my remarks, and we'll turn to Cheryl for her discussion of selected tax issues.
Unmute myself. Thanks, Greg. So Ireland, since we have Vincent on, is actually well-known jurisdiction for investment, international investment. US companies international companies often go through Ireland. So it's interesting, Vincent, that you're thinking of coming into the US. And is that because of the FDA approval and you really want access to the US markets? Do you want to just explain that a little bit more for me?
Yeah, Cheryl, thanks. It was going to be one of my questions. Ireland is probably very well recognized as a friendly tax country. Apart from our wonderful weather, we're known for our wonderful tax friendliness. And so, you know, the question is, what's the best way to structure as an Irish company? Do we want to set up a US entity and as Gregory has kind of ran through, make that the dominant tax position? Maybe it'll become clearer as you run through your presentation.
So we can advance to the next slide, Joan. As Greg mentioned in the overview, the tax considerations that go into where you structure something, how you structure something in the US, it could take a week of description and analyzing all of the nuances. But tax is probably the gating issue, along with where you think your investors might come from and what type of investors you think you may have. So, and in looking at that, you have to look at what kind of tax treaties the US has with these various jurisdictions and various investors, since with many countries, not all countries, the US has a income tax treaty that eliminates or reduces double tax consequences. So for example, the US-UK treaty will reduce the amount of withholding on dividends, will reduce the amount of withholding on interest. And generally, again, if there are treaties, capital gains are just taxed in the jurisdiction of where the entity or the investor is resident. So if you have an Irish investor who invests in a US corporation, and if that corporation is sold, generally speaking, the tax consequence there, I'm sorry, if the stock is sold, the tax consequence lives in Ireland, not in the US. However, if you were to sell the assets of the corporation, then you have taxation both in the US and in Ireland. Another important consideration about how structuring should be done is how you're going to get your capital into the US. Is it going to be literally a capital contribution? Are you going to do a loan? Are you going to do a loan in capital? And all of those have a bearing with your home country, because there are various situations where it's better from the parent company or the non-US company perspective to do loans, so you can take advantage of interest and other deductions you may have in your home country as opposed to the US. And another critical issue is the fact that between the non-US company and the US company, to the extent that there are services going back and forth, to the extent that you've got property, materials, and things going back and forth between the two countries, there are transfer pricing issues. Most countries recognize that they want to make sure that the pricing between related parties is effectively done on an arm's length basis. So and the reason for that is none of the countries want to make sure that income is so skewed that each country doesn't get their share. They don't get their piece of taxable income. And there are separate treaties and protocols on transfer pricing. And again, that can be an entire topic in and of itself. Could we go to the next slide, please? So of course, and this is, I think, stating the obvious, you need people who are experienced both in your home jurisdiction as well as in the US to be able to advise you. They don't have to be tax attorneys. They don't have to be attorneys at all. In many cases, they're tax accountants. In the US, they may be certified public accountants. And then there are entities and service providers who, you know, go down the rabbit hole that are very, very specialized in just certain areas. And they're very beneficial depending on how you want to structure the transaction. And the examples I give are new market tax credits, local tax incentives, the qualified opportunity zone issue. And let me just talk a little bit about that, because to the extent that you're looking for US investors, these opportunity zones, which are relatively new, can be beneficial, because if you want to establish your operations in an opportunity zone, and those zones are driven by census, the background of that is that they want to drive investment into underserved areas. But many of the opportunity zones are actually right next to very populated areas. And I'll give an example. Long Island City, which is right next to Manhattan, is an opportunity zone. Areas of Portland, Maine are opportunity zones. Parts of Boston are opportunity zones. The benefit of establishing yourself in an opportunity zone is that US and foreign investors who have capital gains get very favorable tax treatments if they roll those capital gains into a fund. And in this case, fund is a very limited term. It means 2 or more people. And then those capital gains are actually invested into, for example, your business operating into the opportunity zone. So it is at the moment, largely untapped area of investment funding, particularly for operating companies. It's more well-tapped in real estate type entities, but there are opportunity zone funds that are looking to expand their investment. However, Joan mentioned that we were going to focus on research and development tax credits, and that's what we're going to do today. Which, Joan, can we flip the slide? The research and development tax credit is a very beneficial credit, and it's a misunderstood credit. It's been available to US companies for years and years and years and years. Until 2015, however, it had limitations. You never knew if it was going to continue or not. And people just, they thought when they heard research and development that it was really only for research companies or only for highly, highly, highly scientific companies. So they tended to ignore it. Another limiting factor was, many startup companies for whom research and development is very important, didn't have a lot of income. So if you don't have taxable income, what's the benefit of a tax credit? So just to step back for a second, tax credits offset tax. So if I have a tax credit of 10 and I have a tax due of 10, they wipe each other out, no tax. Very beneficial. Next slide, please, Joan. So the research and development tax credit, the R&D credit, is largely federal, though many states have similar provisions. They might have some tweaks to them, they might have some limitations, but primarily federal, useful to look at what state you happen to be focusing on to see whether or not you want to, for example, if you have a choice between New York and Connecticut, you'd rather go to New York because New York actually has a better R&D credit than Connecticut. Don't let Governor Lamont know that I said that, but it's true. And there are other states that are very, very favorable. I guess most important to know is the R&D credit is not size dependent. Again, most people tend to think of major corporations, research labs, you know, lots of money, lots of capacity to do research. But almost any company that is designing, developing, or trying to improve their products can be a candidate for the research and development credit. Next slide, Joan. So what qualifies for the credit? Developing or designing new products or new processes, enhancing, and this is where a lot of people lose the opportunity to benefit from the credit. If you enhance existing products or processes, that is also qualifying. Or if you develop or improve on existing prototypes or software. So your company, Vincent, as a life science, you got an FDA approval and something, is one that likely would be interested in and could benefit from the R&D credit. Next slide, Joan.
Cheryl, just to ask, is that self-audited, or is there a process that you go through?
Well, there is a process. So each year, if you want to apply for the credit, or on your tax return, you take the credit. And IRS Form 6765 is the form that you would use. It gets attached to your tax return. And it's interesting, one of the questions that I'm often asked is, where do people trip up on the credit? You know, what is it that if I claim a credit and the IRS audits me, what does the IRS usually find as a problem? And that's usually documentation. You know, that you haven't supported the fact that you're entitled to the credit. And we'll get to that in a little bit. This slide just talks about what's not going to qualify for the credit. So after you've begun commercial production, any research that's associated with not improving that production or bettering the process, but if you just are doing research after commercial production, does not qualify. If you have a particular product and you're adapting that to a particular client or consumer's need, that does not apply. If you just do surveys or studies, doesn't apply. Any research conducted outside of the US, Puerto Rico, or a US possession doesn't apply. Why? Because the US wants the work done in the US. And if it's funded by another a governmental entity or something, it doesn't qualify. Your company is the one that actually has to be expending the funds. Next slide, Joan. So when you're thinking about whether or not your company may want to consider the research and development credit, generally look at a 4-part test. Are you trying to eliminate uncertainty in whatever your product or process is? So that's part 1 of the test. Part 2 is you need to demonstrate that you've evaluated alternatives for achieving whatever result it is, and so that you're going through an experimentation process. It does have to be technological in nature. So the experimentation does need to rely on science. It can be computer science, but it does need to be engineering, physics, chemistry, biology, or computer. And the purpose of the research, again, must be to create newer, improved products or processes, increase performance, increase quality, but newer things. Next slide, Jen. We're not going to dive deep into how it's calculated because this is actually one of the tougher pieces of the credit. Generally, you're looking at 20% of a company's qualified research expenses over the base amount. And it's the base amount that gets really complicated. And if you don't have the data for prior years to determine the base amount, it's almost impossible. Next slide, Joan. So there's an alternative calculation method that's known as the alternative simplified credit. And it's much easier. You look at qualified research expenses for the past 3 years. It's much more formulaically driven. And the amount of the credit is roughly 14%. Still very beneficial. And it's just easier to do, at least initially. Next slide, please, Joan. So to claim the credit, you need to evaluate and document your research activities, establishing the amount of research expenses that you paid for each research activity. And when taxpayers try to estimate what they've done, that tends to be where they fall into audit risk areas. Because when you're estimating, you need to have a factual basis for the assumptions that you're using to create the estimates. So if you have very good books and records, if your research is pretty siloed, if it's not, if you can silo it just for expense purposes, your company is going to be much better off with supporting and providing documentation, if ever challenged, that you're entitled to the credit. Next slide, please. We can skip this slide. It's not particularly interesting. So part of the reason that the credit was underutilized in the past is that there were some limitations on what you could use it for. You needed to have taxable income. Also, recently, changes from the 2017 Tax Act have in part made it more beneficial because they've dropped the corporate income tax rate to 21% from 35%. And again, the credit is somewhat complicated on whether or not you can get a double benefit. So it's just worth knowing that the IRS, the Congress likes to tweak tax credits. They tweaked the R&D credit many times over the years, making it pretty frustrating. The most recent changes, however, have been very favorable, and the credit is available and should be utilized. Next slide, please. So let's look at some of the examples of documentation that you would need to support the credit. Payroll records. What have the employees been paid that have been on the particular research that you want to claim the credit for? Your general ledger expense details, any project notes, project lists, other documents that the company produces, and employee testimony. So having your employee, when they say project notes, making sure that the people who created the notes can support what they've created and that they can actually speak knowledgeably about it. A number of the research and development tax credit cases that actually have gone to tax court, good testimony has prevailed and has beaten the IRS in making sure that the company gets to keep the credit. Next slide, please, Joan. So this is one of the important changes that was made to the credit. Again, because so many early stage companies don't have a lot of income, trying to do the documentation for the credit and support the credit just wasn't worth it because they didn't have any income for the credit to offset. Even though you could carry the credit forward, there were some limitations, and it just didn't help small businesses. In 2015, they changed the rules, and so now if you have less than 5 million of gross receipts in the year that you are looking at for the credit, and you have no more than 5 years of gross receipts, so you're a relatively new company, you can take up to $250,000 a year and offset the FICA portion of your employees, of your employment tax. So in the US, there is the FICA tax, which is Social Security tax. Half of that tax is borne by the employee, and half of it is borne by the employer. This credit offsets the half of the tax that's borne by the employer. And it's really useful, it's very important, and it gives you free cash to use on other things. So when I say free cash, I mean, you don't actually have to pay over the 7.5% of each employee's salary that you would have to pay to the government from the employer's perspective. So now you have freed up that cash to use for other things. And the credit is calculated on the income tax return, and you just run through and apply the credit. So it's not that you have to do additional tax filings for this particular piece, for this particular benefit. Next slide, please, Joan. As I mentioned in the beginning, states also have credits. 33 states have them. There are nuances state to state. Some are more favorable, some are not. Like I said, Connecticut is not as favorable as some other states. Massachusetts is pretty good. California, of course, has its quirks. California is a very progressive state when it comes to taxes. It tends to be in the forefront, but it is also challenging for employers to work their way through many of the state issues in California. Why do I bring up California? California is a big technology state. There's lots of research and development. There are many health science companies in California, as well as in Massachusetts. So you do have to go into California with your eyes open if you're going into California. The next slides we can skip over. They're just kind of listing the states that have all the different credits. And with that, I am done. Vincent, do you have any questions?
Cheryl, I think I have loads of questions. Enough to qualify for, as you described it, that week of information that's required to break down some of these. Thank you for that. You did a great job of simplifying what it is, a complex tax vehicle there with the R&D tax credits. Yeah, there are lots of questions that arise. The potential to set up the company as a Delaware company functioning in Massachusetts, and then for the R&D tax credit, do you apply it to where the research is taking place, which would be Massachusetts, or would it be paid in Delaware?
It would be Massachusetts.
In Massachusetts.
Massachusetts.
Okay.
Generally speaking, in the U.S., if you set up a company in Delaware, unless you are actually operating in Delaware, you are going to pay state income tax to the state in which you are actually doing your business. So if you set up in Massachusetts and you also had employees in Maine and some employees in New York, you'd be paying taxes in Massachusetts, New York, and Maine. Not in Delaware, except for a fairly minimal annual tax.
Okay. Yeah, and that comes back to your point earlier that it's probably good to employ a good tax advisor, right?
Yes. and both in Ireland and in the US, because the cross-border issues, are complex, and with the right structure, you can end up with benefits both in the US and in Ireland, or in the US and whichever country in the EU or India, wherever you're set up. And also, Greg, I think touched on this a little bit, depending on where your investors are coming from. So if you have investors in the US, but let's say they're tax exempt investors, and you don't, for whatever reason, it's more beneficial for you not to use a corporate form, those investors actually may want to come in through a foreign vehicle.
And so just a question on the investors. They'll pay taxes in whichever state they're based in as well, right?
Correct.
So they may have a preference that the company would be formed in whichever state they're based in. Would that make a difference? Greg,
goes back to structure, yes. And that would be more likely if it's going to be a pass-through structure. So if it's going to be a limited liability company. And part of that also is going to be driven by who your executives are, who your employees are. Are you going to give an interest in the company to individuals? If you are, they prefer a pass-through as opposed to a corporate form, while true investors may prefer a corporate form because they don't want phantom income passing through to them. So again, there are so many tax questions that drive where to form, how to form, who your audience is going to be, and then what's overall best for the company.
Yeah, and I think it's that. I mean, we have to consider it firstly from our own perspective, what's overall best for the company.
Right.
But as we're, and I'm speaking only for Gascon here, but as we're looking to enter the US primarily right now for investment before we build on and get to that commercial sales stage, the idea that Gregory, that you brought in earlier, that investors can have a preference over the type of company that you set up.
Mhm.
And therefore, you kind of almost have to identify those investors, identify their particular interests in their own tax situation, and then look at setting up the company based upon all of those kind of grounding points.
That's
I will
right.
say, Vincent, if
It's a
you're
complicated discussion.
yeah.
Yeah.
If you are interested in tapping into the opportunity zone funds and the investors who are within those funds, there actually are, I think, two organizations, and I can send the information to Joan, where a lot of these opportunity funds have identified themselves.
Yeah.
It's not required in the US, but the list is there. And so you can see who's in the area that you're interested in and whether or not their focus is your focus.
Yeah, perfect. Thanks, Cheryl. I actually had that down as a question. Is there a list of these funds?
Yes.
So you're ahead of me yet again.
I have a question, Cheryl, about the opportunity zones. The session prior to yours, we had a number of our life science incubators pitch a little bit about what they can offer to startup companies. And I think many of our incubators are in opportunity zones. We sort of look at the incubators as a first good office on the ground here, a low cost, flexible way to land here for international companies. So is that eligible? Then if a company takes an office in an incubator that's in an opportunity zone, is that company then eligible for tax credit, tax incentives?
So if
Incubator.
they lease the space from the incubator and then they do, they employ employees in the zone and develop business in the zone, yes, they would be eligible. So both your incubator and your operating company, depending on what else the incubator is doing, could probably both qualify for investment from the funds.
Okay, good.
You don't have to own property in the zone to qualify.
Okay.
It's more important that you're actually doing business in the zone. And what the states and the federal government really want to see is employment and manufacturing or product development in the US in those zones. Because what they want to do is they want to drive money into those areas. Employees spend money, companies spend money, you develop the area, it lifts everybody up.
And your investors, once you attract that kind of investment, they're going to want to tie you to a place because these tend to be geographic in nature, and you can't just like establish in an opportunity zone and then flit around the country, move to other places that are not in opportunity zones without creating real headaches for the investors. Is that right, Cheryl?
Yes, to a certain extent, that's true. However, you can flit around to other places in other states that are also opportunity zones.
Right.
So you don't have to just be in, for example, a Massachusetts opportunity zone. You could be in Massachusetts, you could be in New Hampshire, you could be in Iowa and Texas. As long as you're in zones, you're going to qualify for those the funds. And I don't know, Joan, if in the last session there was a discussion about the benefit to the investors. It's a big tax benefit.
Yeah.
As long as they can hang in there for 10 years, it's a really nice tax benefit because they're not paying tax on any appreciation in the investment so long as they've held it for 10 years. In the US, tax goes away, tax-free.
So Cheryl mentioned that it's often used for real estate investments because the real estate doesn't move around, and it tends to be a long-term investment. So it fits nicely over the lifespan of an expected, opportunity zone investment payback. Whereas operations are more movable, and they live and die, and all sorts of things happen.
However, under the fund rules for the opportunity zones, if, for example, you had an opportunity fund invest in your company did phenomenally well, it sold after 5 years, the fund could take that and invest in another opportunity zone company for the remaining 5 years and still get the investors that benefit. So there are ways, and they tried to make this particular tax benefit as favorable as possible. So it's a good thing to know.
Cheryl, just how well understood is that by investors? You mentioned that it changes, and it has changed in the last couple of years.
The opportunity zone is new since 2017. At first, people were very reluctant to invest in them because there were no rules, there were no regulations. It literally was thrown into the 2017 Act at the 11th hour. It was, a couple of sentences, and that's what it was. In 2018 and 2019, the IRS issued regulations which made investors much, much more comfortable. And so now money is flowing through the zones pretty nicely. Again, primarily, part of the reason that real estate is popular, at least through this point, is because many real estate investments had already been started. And because there are timing issues on the investors rolling their capital gains into these funds, they needed things that had already been started. That has loosened up a little bit because the regulations that have been proposed allow a slightly longer glide path to get the money in and get the money used. But initially, it was a very short, basically had to flip it in 180 days, meaning get the money in and start to get it used. And so already existing investments or things that were under development got the money because they were already on the ground, they were going. But many funds are looking for good companies to put them money to use.
Okay, I'll probably connect with you. Just you said you could provide a list of those funds.
Yeah, I can send you. I think it's 2 links, and the funds self-describe what they are looking for investment. So you just kind of run through them, look at the states, look at the types, and generally you can just email them.
One final question, just on the R&D tax credit. You mentioned that it's available on new products and processes. Obviously, we have to provide some evidence that there was an initial product, and then is it available on iterations of that one product?
If you are improving that product, so if you have a product and you've decided that it's better to go Y than X, and you justify that X just isn't working that well and Y is a much better direction, you would be able to take the credit on Y because you've shown that you need to do the additional research and the additional experimentation to make the product better or more feasible or feasible in general. So I know you said you got FDA approval. Assuming it's a drug or something, you may have started down one path and realized, yeah, it was okay, but really not the efficacy that you needed. And you decided all of a sudden, okay, now I want to go a different path, and I want to go that different path in the US. Yeah, you'd be able to take the credit for that.
Okay, thank you. Thanks for that information.
We appreciate your time today. Thank you. Thank you, Vincent, for being with us for your afternoon.
Yeah, once again, just to say thank you for the insights, and we look forward to staying in touch.
Glad to help.
Okay, well, have a good afternoon, all.
Thanks. Bye-bye.
Bye.
Bye.